Welcome back. Thanks for staying tuned at your Mutual Fund Corner on CNBC TV18. Now let's continue the conversation and actually talk about investing directly in stocks versus mutual fund investments. What is a better option for you? And why are we seeing that retail investors actually lose money in direct stocks most of the time? To talk to us about all of this, we're going to carry forward this conversation with Tarun, who's here with us. Tarun, this is such a common phenomena that we've seen, right? Because when you're directly investing in stocks, there are investors who make more losses in this fund versus obviously managed funds or PMSs, index funds. Main criteria or mistakes that people make while doing this, and why should they be preferring mutual funds over this?
Great. So I will start with a lighter note. So what I'm observing is, if there are two brothers in the family, one brother is managing the factory, other brother is managing investment, or he's a full-time trader in the equity market. So this is a pattern which this bull market in last 3-5 years has resulted in many so-called traders or investors have been born. And I think which I feel is somehow not going in the right track, because I am a strong believer of that camp that trading can never make you money. And if you see the NSE data also, where 90% of the traders lose money, that is one data which has been very clearly validated. Again, let me give you some very important numbers. As we talk from 26 September, we have seen the Indian markets have started falling or correcting, where the broader indexes are down anywhere between 13 to 15% in this time. We have seen almost like 66% of the BSE 500 stocks are down more than 30-35%. That is the average number of fall in these stocks. And I have seen last year was a year where most of the new IPO, and we have seen almost like 300 plus offers for sale and all these schemes in the market, where almost like most of the promoters have sold in the market. These newly listed stocks are down anywhere around, that index is down almost 37% from the peak level. So you can see the kind of fall or the correction we have seen is very high compared to, if you look at normal funds, diversified funds, it has been much lower. Indexes, it has been much lower. What I'm observing is one of the big reasons for this thing is survivorship bias. And there is a very important behavioral bias called survivorship bias, where if you see in every last 3-5 years, the top 50 stocks or top 30 stocks in the markets keep changing. The rotation of the leaders keep changing in the market. So like Reliance and Infosys survived, but what about stocks like Yes Bank, DHFL or Anil Ambani group companies, right? These stocks have gone out. But what we have seen is investor ability or skill to change this in their portfolio is very low, because I think the domain expertise is lacking, because it is a full-time work according to me. So, and again, the decision like portfolio sizing. So let's say if you have 15 stocks in your portfolio, how much you should have? Let's say 5% of your portfolio in stock A versus 7% into stock B, or the concentration level. I think as a professional fund manager, I see there are a lot of tools available. There is a lot of structure which is available to ensure the portfolio is diversified, and this survivorship bias risk is taken away. Again, benchmarking against the index helps them to keep rotating portfolio. But again, one of the very important reason investors lose out in direct equity more compared to managed fund is the behavioral bias, right? Based on a Dalbert study, which is like the leading research agency, investors have lost almost like 3 to 5% more compared to index investing because of the poor timing. Most of the investors invest at the peak of the market and they sell at the lowest level of the market. And we have seen this time and again happening. And I think as we talk today, most of the investors who are out of the money in the stock, they're selling their stock. Again, there are time and research constraint for direct equity investor. I think they have become investor based on some friend telling them they picked up in their portfolio, but nobody has researched that. So all these things are very large reasons where we have seen the returns are not appropriate. Again, there is no goal-based investing mechanism in this. So I feel this is a big science. I can take a full day workshop on this if you ask me.
Yeah, absolutely. But when you're investing, some of the concerns that I hear also from direct investors into the stock market is that the fees on that concern, whether they're going to be paying higher fees from the mutual fund side or a PMS side versus on the direct side. Is that something, and how could one be addressing that concern? Is this just a myth?
So I just feel one need to be aware of a very strong concept called MVOT, money value of your time, right? So the time you will be investing in managing your own fund versus someone else managing your fund, one need to be aware, right? Let's say if I make X amount of money as an income every year, if I invest more time in upgrading myself, I will make more money in that, right? So investing, if you are spending say 10 hours, 15 hours in a month, I think that according to me is opportunity loss, right? I think if you look at somebody professionally managing and he would be charging, let's say 1%, 1.5% to manage the same, I feel that is worth the time compared to something which you can't manage because you are getting a professional expertise, somebody who is helping you in stock selection, the mistakes which you would be making, diversification in your portfolio. Again, higher risk adjusted return. We have seen most of the funds have delivered a better than index return. And if you feel the cost is high, you can pick up indexes also. Indexes are available at much cheaper rate compared to the active funds. But I feel managing yourself, if you don't have the know-how or domain expertise, it's not going anywhere. That is what I am observing.
Absolutely. Thank you so much for that, Tarun. Tarun, actually, we will have to take one of those full day sessions with you on this topic, but we are out of time on this edition of Mutual Fund Corner. So thank you so much for joining in with us and giving us a bit of an insight on this one as well. It's a pleasure having you on the show. And with that, we're absolutely out of time. So thank you so much for tuning in. Up next, we have Closing Bell.